How is my UK pension taxed overseas? So in this short video, I'm going to be discussing how the UK pension is going to be taxed when you live overseas, and this is breaking down the 25% PCLS part of the pension. It's the 75% income part of the pension as well, understanding how double taxation treaties work, and then also how these taxation rates are going to apply to you. So first of all, we need to understand how a UK pension is taxed in the UK. It's very, very simple. 25%, which is called the PCLS, which stands for Pension Commencement Lump Sum. This is paid out tax-free. The other 75% is taxed at your marginal rate. Okay, so if you're working, then it's going to be applied on top, but you would just pay income tax in the UK on that 75% portion. Once you leave the UK, it gets a lot more complicated because first of all, you need to understand what the double taxation treaty says between the UK and the country of where you're living. If there isn't a double taxation treaty, it could mean that you could pay tax twice. So first of all, you need to understand how that would work in principle, but then also you need to understand what the treaty says between both those countries, because sometimes the UK pension could be taxed in the UK, sometimes it could be taxed in the country of where you're living, sometimes the PCLS part is taxed in the UK and the income part is taxed in a different country. So every country will have different rules applied to it, and it's important to understand how those rules do apply. We have an up-to-date list of the DTAs between the UK and each country around the world, so we can easily tell you how this tax rate is going to apply, whether that's the PCLS part or the income part. So let's just say you're now living overseas and you want to find out how this is taxed. You definitely need to understand what the UK is going to do, because the 25% PCLS part, that's always paid gross of tax. So even if the DTA states that there is tax to be paid in the country of living, where you're living, which generally would apply with the PCLS, it's often taxed. It would always be paid gross of tax from the UK. This is not the case for the income part. So this is where people often get stuck. Let's just say, for example, you've taken your PCLS and all you're left is with the income part of the pension scheme, and you decide to take £50,000 from your UK pension scheme. What HMRC are going to do, they're going to assume that you're taking £600,000 from the pension in that given year. So they multiply 50 by 12, and then they're going to tax you as if you had a £600,000 income. So this means you're taxed at 45%. Okay, this is really, really punitive, and they have been discussing changing this in the future, but as it stands, these are the rules, which means you have two options. You can either apply for the tax back, and this needs to be done within a certain time frame. Please don't leave this for many, many years. And to apply for it, you need to contact HMRC and fill in the tax return. Now, this is not a straightforward process. We had a client 3 months ago. They filled in the forms and they said that they were not, HMRC said that they will pick up those forms in 6 months' time. So it was I don't know, 8 to 9 months just before they reviewed the documents. So you need to make sure those documents are correct. Otherwise, that's going to delay things for even more months. But if you're wanting to access the money today, then that's not going to happen. The other option is to apply for something called an NT tax code. Now, this again is not very straightforward. An NT tax code stands for no tax, and it's a tax code that applies to people that are living outside of the UK where their income can be paid gross of tax. Now, you can't always apply for this. If you do have other income in the UK, you may not be applicable to apply for an NT tax code. If you only have, for example, a state pension, then that's okay. But if you've got anything else, please contact us and we can let you know whether or not you do qualify for an NT tax code. If you do, it's a very, very long process to get this applied. Best case scenario we've had, which was 6 years ago, took 9 months. Generally speaking, it takes more than 1.5 years. And you have to be very proactive with HMRC to make sure you chase them up to apply this code. Okay? It requires filling out a form. There could be a specific NT tax code form based on the country where you're living. If not, there is a generic form. and it's a case of filling this form in. There needs to be a tax code applied to the pension provider of where you're taking the withdrawal, and once that's applied, you can use that tax code to apply for the NT tax code. You will need to go to the tax office in the country where you're living and get the form stamped. So again, it's not very straightforward and does require a bit of effort on your end, but our job for our clients is to help educate our clients to be able to do this process and to make sure eventually the money can be paid gross of tax. So let's just say, for example, you are trying to withdraw all your pension in one go, you need access to your funds within the next 3 months. It's unlikely that's going to happen based on the current legislation, the current rules. But yeah, as you can tell, it can be very complicated. And this is a big reason why, if you do leave the UK, pension providers in the UK do not want to open themselves to anti-money laundering or taxation problems, which means you often have to transfer to a pension provider that's available for non-UK residents, where a financial advisor like ourselves has to be appointed to the plan.